This is the continuation of Chapter 6's lecture. We've already gone over sole proprietorships and general partnerships, and we talked about limited liability partnerships. Limited liability partnerships is where your liability is limited, but you still have to claim the income on your personal taxes. So the next thing I wanted to talk about is corporations. So the advantages of the corporation is that it's limited liability. In other words, the people that have stock in the company cannot be held liable if a little old lady comes in and trips on the welcome mat. The liability is limited to the corporation itself. And one way to kind of look at a corporation is to say that corporation is basically a person in the eyes of the law. It has its own tax ID number. It files its own taxes. So the corporation itself would be the person responsible for the liability. Another advantage is it's permanent. Just because a stockholder dies doesn't mean the corporation has to dissolve like in a sole proprietorship. It's easy to transfer ownership. You just go and buy stocks from a broker. The ability to raise capital. Corporations are able to get money either by bonds or stocks. And the ability to use specialized management. And this is kind of a really important thing that people tend to overlook. In a small, privately owned, one owner company, the person that owns the company has to do everything. And they may not be specialized in HR and management and accounting and business law and all of that stuff. But in a corporation, you can hire people to do that. And people are more willing to work for a corporation. Now, of course, there are some disadvantages. The expense and complexity of forming a corporation. Very complex, typically. Believe it or not, most corporations are formed in Delaware because Delaware has very favorable laws for corporations. So if you ever look at a corporation and see that they're out of Delaware, that's why. Complications when operating in more than one state. So I explain this by, do y'all know what the minimum wage is in Oregon? It's $17 an hour. The minimum wage in North Carolina is $7.25. Imagine having to know just something as simple as the minimum wage in every state. So when you're working in more than one state, it gets very complicated because every state has different laws. So it is kind of complicated. And that, again, goes back to being able to use specialized management. Double taxation. We talked about this Tuesday in class, but because the corporation is its own person, the corporation has to file taxes. So the corporation pays taxes on its profit. But then, if it splits its profit with the people who own the company, the stockholders have to claim their share of the profit too. So that's called double taxation. Probably one of the biggest disadvantages to a corporation. More paperwork, regulations, and less secrecy. After the Enron and a lot of the scandals of the early 2000s, there were a lot of national bills passed to keep that from ever happening again. The Sarbanes-Oxley Act is one of the most well-known. But now in corporations, the actual CEO has to sign all of the tax forms. Any of the forms, they have to be made public. And if for some reason they are wrong, that CEO can be held liable and may actually go to jail if that information on those forms is not presented as correct. And the last disadvantage is not something super common. Your book talks about this. It's called conflicts of interest. And this is when the board of directors of different companies serve on more than one board and they could have conflicts of interest. So let me give you an example. If somebody, Lee Iacocca, who you wouldn't know probably, but he turned Chrysler around in the 80s. But anyway, if Lee Iacocca was on the board of Chrysler and on the board of Ford, that would clearly be a conflict of interest because he's getting information from Ford and taking it to Chrysler. So there's a lot of laws now that prohibit this conflict of interest, but it is something to keep in mind. So I want to talk just a little bit about corporate restructuring. You've probably heard this before. Mergers are when two corporations, it's a combination of equals. You may have heard years ago, Chrysler and Mercedes-Benz merged. One of the worst mergers in the history of mergers. It just didn't work out. Their cultures were completely different. You have Mercedes-Benz, who was very engineering oriented, high dollar, attention to detail. And then you had an American Chrysler who had just gotten through a lot of complaints about its quality. And these merged and it was awful. Now Chrysler is owned by Fiat. Acquisitions is when one company purchases the other company. So I haven't heard of a lot of acquisitions recently. Several years ago, Sears bought Land's End. So they just went and bought the company. And divestitures is when a company spins it off. So let's just say Procter & Gamble spins off a company and makes it a new company. So Procter & Gamble makes Tide, okay? So Tide is not its own company. It's under Procter & Gamble. But let's just say Procter & Gamble gets tired of dealing with Tide, so they make it its own separate company, and they, cut their ties with Tide, and it's its own company now. So those are the three differences between corporate restructuring. Something to think about just so that you know what it is. So we've talked about sole proprietorships, partnerships, LLCs, and corporations. But there's one type of business entity that we have not discussed, and that is franchises. We all know about franchises, okay? So there's two types of franchises. There's the distributorship. The best way to think about this is cars. Ford makes the product, and then the franchisee sells it. So Randy Marion is not making Fords in the back of his lot. He's just selling them. So that's called a distributorship. A business format franchise is where you make and sell the product under strict guidelines. All right? So McDonald's, I believe, is headquartered in Illinois, but don't quote me on that. I'm not 100% sure. But your Big Mac is not coming from Illinois. It's made at your local McDonald's. So that's the difference between the two. And most of the time, we think about the business format franchise when we say franchise. So the advantages, they're less risky. You get training and support. Brand recognition. Who doesn't know what a McDonald's is? And they're easier to get funding for. And most of that falls under brand recognition. I mean, who doesn't know McDonald's? And because everybody knows McDonald's, there is a less risk. And we've all heard about, I think, Hamburger U, that's it, for training and support. Now, there are some significant disadvantages to franchises. They are expensive. You lack the lack of control. You've got to do what headquarters tells you to do. Even though you may think that here in North Carolina, throwing coleslaw on a hamburger sounds good, you can't do that because the headquarters won't allow you to do that. There's something called a negative halo effect. And what that means is that maybe you've had a bad experience at McDonald's. And so now you think every McDonald's is bad. So I know people that don't eat at McDonald's. Well, actually, pick a fast food. I probably know people who don't eat at one of them because they had a bad experience at one. And so now they kind of lump all of them together and say, I will never eat at McDonald's again. There are some growth challenges to franchises. Some franchises will limit the amount of buildings they have within so many miles. Restrictions on the sale of business. So let's say you own a McDonald's and you're getting older and you want to get out. You can't just sell it to anybody. McDonald's has to approve who you sell it to. And finally, poor execution by the franchisor. So what this means, typically the franchisees that we all know have good management. But some of the lesser known franchisors may not have the great management styles. We typically think of fast food as being, all of franchise, but that's just not true. A lot of franchises out there that have nothing to do with food. And I think I'll go over that in just a minute. So a franchise agreement is a legally binding document. When you buy a franchise, that's the document that you sign. A franchise disclosure statement has to say how the franchise is doing, what are the 100 current franchisees. So if you want to buy, you can talk to them. So this is just a fun fact when you stop and think about it. Now, this is not in terms of sales. This is in terms of locations, okay? The number one franchise in the United States is U-Haul. There's like 5 of them in Statesville alone. Now that, again, not in sales, but just in terms of locations. And U-Haul has nothing to do with food. So I'm just going to leave this here for a few minutes, just so you can kind of see the largest franchises and the fastest growing in North Carolina. Now, some of them do have to do with food, but hotels, Ace Hardware, H&R Block, the UPS store, Hertz. Now, these are all in terms of receipts, in other words, sales. In North Carolina, I think there's only one. Yeah, Teriyaki Madness, which I have to admit I've never heard of. But that is the fastest growing franchise in North Carolina. Or that list is the fastest growing. So, just to recap, there's 4 basic styles of ownership or of forming a business. Sole proprietorship, which unlimited liability is the biggest disadvantage. General partnership, again, unlimited liability. Corporations, double taxation. And then franchise. And I don't know what the biggest disadvantage. I'll let you all figure that out. Because I'm such a control freak, I'm going to say lack of control. But maybe cost too, because some of these franchises, you got to be super, super rich to get them. Okay, so there you go. There's your lecture on Chapter 6. If you have any questions, please let me know.